Coming up on today's show, the Trump volatility is back and what it means for the market, the economic data we should all be very concerned about, the FOMC minutes and its implications for yields and the dollar, and why this chart is a precursor for 2025. We've got a lot to talk about. Let's roll the tape. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks were lower on Wednesday as investors absorbed a report that President-elect Donald Trump is considering declaring a national economic emergency to pave the way for proposed tariffs. Meanwhile, minutes from the Federal Reserve's December meeting showed many officials supported a gradual pace of interest rate cuts in 2025, and it was very mixed price action across the board. We had some of the mega caps outperform Microsoft, Tesla, some of them underperform like Meta and Google that brought the entire communications sector down. However, there definitely was green in a market that was relatively flat today. We did see quite a bit of green here in software imposed against some of the red we saw in semiconductors. Financials was very, very mixed, but we did see quite a lot of buying here in healthcare, Eli Lilly, United Health, Stryker Corporation. In fact, medical devices was probably one of the best performing subsectors today. But industrials was positive, real estate was positive. Anything that was tied to the domestic economy and that was void of tariffs, they did very, very well today. Other than that, it was a very lackluster day across the board. There were winners, there were losers, with the best winner being XLV, the healthcare sector, followed by materials, industrials, discretionary, real estate, financials, and staples. In fact, more sectors did gain today than lost. However, the SPY was virtually unchanged. That's because we had the XLK see a loss today along with the XLC, which was the worst performing sector on the back of some of the price action we saw with Meta and Google. And we saw the Trump volatility come in full force. We saw many stocks just pair gains here early in the morning, and then we had a relief rally. Then we had more selling midday, and such went the market today. Very volatile trade, more of a day trader's market more than anything else. But net, we were flat. We did see large cap growth gain ever so slightly along with mid cap growth, but that was really it. I mean, large cap core did gain too ever so slightly, but yeah, it was a pretty brutal action in the broader market. Value was very, very ugly today, an ugly trade. Mid cap core as well as just small caps across the board. The market didn't want anything to do with small caps. Net though, a general flat day in the market, especially when you have large cap growth. You're pretty much flat here for the day, but we did have some major market movers. eBay was up 9%. They soared after Meta said it will allow listings on Facebook Marketplace in the US, Germany, and France. I'm assuming this will be rolled out to the rest of the world. eBay was up 9% on the back of this. They got a very, very early boost and a bit of consolidation as a result. Now, this was absolutely crazy, guys. Quantum computing stocks, and it wasn't just IONQ. It was QUBT and a whole bunch of other stocks were down anywhere from 40 to 50% after Jensen said the technology is decades away. And all of this and all of the euphoria that came with quantum computing in one single statement, one single comment, they absolutely got demolished. However, a lot of these stocks are up like 1,500% in the last year. So, you're still net. If you've been in them for the last year or so, you probably are still up on your overall position. But let's actually talk about the real volatility today. And it had to do with Donald Trump. He came out and said he's considering declaring a national economic emergency to impose tariffs. The move would allow President-elect to implement broad tariffs after threatening Panama, Greenland, and Canada. This report comes 2 days after we got a report from the Washington Post suggesting that Donald Trump won't commit to an aggressive tariff plan. So we are starting to see the early signs of what comes with the Trump presidency, and that's volatility, especially with the news cycle, because stocks can move up, stocks can move down. There's a lot of people that Trump turns the wrong way, particularly in the media, and so expect much more of the same for the next 4 years, guys. And as a result, when you look globally, we saw much of Europe, much of China on the back of Trump's comments, as well as South America, pretty red. And that's because tariffs are going to hit these countries the most. And then we saw South Africa, my birth country right here, very, very red. But my home country, Australia, pretty green, along with the US, which was kind of green, but mostly held up by the mega caps. Now, it wasn't just Trump causing volatility today. We did get some very subpar economic data. Now, initial jobless claims saw 201,000 versus the 218,000, and we actually saw a positive revision into last week's numbers. That's what this green thing means. If it's red, it's a negative revision. Now, I wonder if the initial jobless claims coming out a day early did affect this number missing. Maybe the actual number would have been a little bit better. That's why I think the market didn't put a lot of weight towards initial jobless claims this week. However, ADP employment did miss as well, 122 versus 140K. We are seeing weaker than expected labor market data, and that doesn't really bode well for the NFP. So the market is trying to price that in and what the non-farms are going to look like on Wednesday. And then we also got the FOMC minutes, and those minutes released on Wednesday showed many officials favor a cautious pace of cuts in 2025, citing factors like elevated inflation, strong consumer spending, and labor market resilience. While inflation is expected to trend towards the 2% target, officials noted recent higher-than-expected readings and potential trade and immigration policy changes could slow the progress. The Fed's careful approach highlights lingering uncertainty as they navigate economic risks. However, Fed Waller did come out today and say he still sees two cuts in 2025, despite Trump's tariffs talk. So some officials still saying we're going to get red cuts, but the overall broader sentiment saying we're here to wait and see and react to the market. And again, everything culminated in what we saw today, and it was pretty ugly breath across the board. 4,300 decliners, 1,900 advances, but we saw a lot of the mega caps here were pretty much flat to slightly positive, and that's why the S&P 500 and the broad US market was kind of flat, slightly positive today. But because of what we saw with small caps, that's why we saw a huge amount of decliners. Nonetheless, market breadth still looking a little bit shocking, and we actually did go ahead and lose the 150-day, and right now the 200-day right is holding on by a very, very thin straw. Not looking good. We did see a little bit of market breadth improvement to kick off the week, to start the week. However, that has since dissipated into the rest of this week, with the only hope right now being the 200-day moving average. If we lose this, that's when algos can get really aggressive to the sell side. If we lose the 200 moving day average, we might actually go ahead, make lower lows here in the market. But let's quickly hop on the charts. And you can see very muted price action across the board. The S&P 500, Nasdaq 100 virtually flat, but the IWM is down 0.56%. But look at the RSP. This is very constructive. The RSP was flat, and there was a lot of market moving events today, particularly from the Trump campaign. Net, we did see mid caps kind of flat, profitable small caps down 0.14%. So the IWM, the Russell 2000, so high beta was the only laggard here today, but the market was kind of sanguine for most of the session. However, what we did see today was yields fall on the back of what Trump said, as well as the dollar rise. Very interesting. Bonds gained ever so slightly as a result, but because of all of the news, we did see a little bit of hedging here in metals. Gold gained, silver gained, nat gas gained 6%, very volatile, and WTI was down 1.43%. So we did see a little bit of a rotation here in equities. We did see a bit of a move to the dollar, a bit of a move to bonds as well as gold, just these safer haven assets after all of the news that we actually got with Trump, and anything that has to do with international policy, foreign policy, geopolitical news, you're going to see like bonds and the metals really peak up relative to equity. So the place to be certainly was in bonds, it was in the metals. However, don't discount the fact that if it's kind of flat in equities after today, that's largely a positive sign. And we did see yields fall, and that sort of did support, I guess, the broader market stuff like the RSP and the large caps, relatively speaking. Nonetheless, we continue to do what we've done all week, and we're kind of just balancing at this zone, the 5860 zone. This has become a very crucial zone because we used it as resistance here in the S&P 500. It is then turned to support on multiple occasions for us, and it looks like it is supporting us again. You can see if we actually zoom into this candle right here, We did get selling at the highs, yes, but we also did get buying at the lows. And that's where we are right now with this candle, which is what we call a shooting star candle, where we didn't see a winner of buyers or sellers, but the market trading at where it pretty much opened. Now, the market is open for about another 10 minutes, guys. A lot of you have been asking, why do I actually record this before the market open? Well, that's because I have a full-time job and other parts of my life. So, and I am living in Australia. So when I have to record these, I'm very limited on time. I don't live in America. Nonetheless, guys, the S&P 500 continues to do what we're doing. And we say as long as we hold this put support level right here and it doesn't move down, that's very, very positive. It hasn't moved down today. And that's very good because that will likely mean this put support is going to support the overall market. They call this the put wall. This is the core wall. This is the gamma flip, guys. At any time you're above the gamma flip zone, you want to buy, dip, sell, rips, because that's how dealers hedge. They buy into weakness, sell into strength, and generally we see bullish price momentum, whereas in negative gamma, dealers sell into weakness, buy into strength, and then you get this volatile price action. And that's why you generally see below the gamma flip, we get very volatile price action. Look at this movement right here. And then above, we actually get like very linear price action, right, in positive gamma. And that's the difference between the two. Now, in negative gamma right now, we're trying to see if we hold this level. Two things happen. If we hold this level, move up back into positive gamma, consolidate here, and then we can move onward and upward, maybe break this and go to the core wall. However, if we continue to see the volatile price action we're seeing and we break the 5860 zone and actually consolidate here below the zone, then we probably will move lower, close the gap we saw right here, and probably trade to as low as 5,700 in the S&P 500. So it's very, very two options. Right now, the bulls need to hold the level where we're at right now. That is exactly what they're doing. We have seen very, very solid buying here at this area. However, if the bears get greedy, if the bears start to make a move and we do go lower, things will get ugly very, very quickly. So we are in a wait and see mode right now for the S&P 500. The same is true for the Nasdaq 100. You can see we're right here at the put support. The exact same thing is happening. We need to consolidate here, move up, get back into positive gamma if we want to see higher prices. Otherwise, if we break below this level, we could definitely see lower prices in the Nasdaq 100, and that will definitely coincide with stuff like the put wall, the put resistance moving down to lower levels, and that's not going to be good. Nonetheless, what we are looking for in Q1 right now, guys, is for a dip. If the put support level holds right here, this is the Q1 dip. However, if we go ahead, break below this and consolidate here, we will see lower levels, and then we will actually be looking for a lower level in Q1, definitely towards the later end of January into February, possibly as late as March. However, we are still looking for that opportunity to get long, that dip in Q1, and it may be where we are right now. It may be lower. We're simply reacting to the overall market environment right now. And what we definitely are seeing in equities is a correction in time. Not so much price. Peak to trough, we haven't really felt that much. If you measure where we are right now, 5%, it's a garden variety pullback. This is the volatility you just get in the equity markets. It's really nothing. But what this volatility is giving to us is simply a correction in time. As you can see, from pretty much the start of November to where we are right now, we're virtually flat here in the Nasdaq 100. And if we actually zoom out right, you can actually see that if we take the high right here and sort of measure it, we are kind of almost flat since like mid-July in the Nasdaq 100. And this is a correction in time. Yes, we've had very volatile swings to the downside and the upside. However, what we really are seeing in the market right now is simply just a correction in time. And that's really good, and it bodes really well for valuations, because valuations right here look insanely extreme. Whereas right here, yes, they do look elevated, but not as elevated as they were right here when most of 2024 earnings weren't priced in. So I think a lot of the market momentum we are seeing bodes really well for the rest of 2025, particularly with what the mega cap earnings are going to do for the rest of 2025. And then looking at the RTY, guys, down 0.42%, a very ugly day, but it's doing exactly what the S&P 500 and the Nasdaq 100 is doing, and that's it's holding the support level, the put support level, and that's exactly what you want to see. You want to see this put support hold, because that means we can actually use it as support and then move higher, retake the positive gamma zone, and then we can just make our way to the core resistance, and this is virtually all-time highs for the Russell 2000. Then if we actually go ahead and break this level, it would mean lower prices for the Russell. But based on like 40 to 50% earnings growth for the Russell, I think any dip we do really get, you just want to buy that dip, because if these earnings materialize, the Russell is really, really cheap, all things considered. But net, guys, today was a very flat day in equities. We're actually seeing now as the market moves for about 5 minutes from close, the S&P 500 up 0.2%, the Nasdaq 100 down 0.15%. So a bit of a deterioration in the mega caps, broader market gaining. The RSP gained ever so slightly there. We're seeing mid caps gain as well. So we might actually see a little bit of outperformance here in the broad market. And we did see metals peak up ever so slightly, just a little bit. And Bitcoin was down 3%. But all in all, guys, you know the game plan. We're looking for an opportunity to get long in Q1. This may be the opportunity where we are right now at the S&P 500 and the Nasdaq 100. However, if we don't hold this level right here, the 5860 level, we will actually see lower levels in the S&P 500, but that must coincide with the put wall moving lower as well. So all in all, guys, be reactive to market momentum and embrace the volatility we're seeing right now and expect more of the same. And diving into sentiment, this is CNN's Fear and Greed Index, and something we've seen for the past couple of weeks is that the market has stayed solidly in this fear territory. And when we stay in the fear zone for a while, it signals bearish sentiment. Investors are cautious, selling stocks, taking profits, and maybe even shifting towards safer assets. This can lead in turn to lower stock prices, volatility, and consolidation. However, for contrarian investors, prolonged fear is actually a buying opportunity, as markets could potentially be oversold or overcorrected. And something that could drive positive momentum in the month of January is actually the first 5 days. It is shaping up very, very well so far. We have one more day here in the first 5 days of January, and we are going into this day very, very solid. And guys, when we have a positive first 5 days of January, it bodes really well with average returns of 18%, median returns of 15%. And you can see the hit rate here of 83%, very, very solid seasonals, especially when you look at the entire year. And in a post-election year, we should actually see much of the same like we did in 2024, although not to the same degree that we did. Post-election cycles tend to see higher highs, higher lows, but not without some consolidation here in the first quarter of the year. And this is normally because a new administration comes in gunslinging, executive orders, new policies right off the bat, and the market has to price in the uncertainty. After it does that, the market climbs the wall of certainty as well as the wall of worry that comes with the year, where we make higher highs, higher lows, returning an average of 8.8% in a post-election year. Now, a big comment I've seen a lot of people make is that we can't really go higher because of valuations. BofA have come out and said the S&P 500 is likely to return 3% over the next 10 years, annualized, some very bearish stats. However, it's very rare to see significant multiple compression in periods of above average earnings growth and accommodative monetary policy. When you look at the median 12-month rate of change on the forward PE, when earnings per share is expected to grow 9% or more, which is above its historical average, you generally see very positive market momentum. Pretty much what you see is average returns of 9%, median of 9.1%. In other words, indices do rally in light of high valuations. However, if it's backed up by earnings growth and accommodative Fed policy, which we are in a cutting cycle, you see very solid returns, a 91% hit rate. And look at the risk to reward. The maximum upside and the minimum up. This is a sample of 34 different periods, guys. You could see a 22.6% reward versus a negative 4.4% risk. That is risk to reward you take with average returns of 9%. In other words, guys, regardless of valuations, you really just want to buy and hold equities in this type of environment. However, I wouldn't even say valuations are that high, because when you adjust for quality metrics, innovation has grown significantly in the S&P 500. It has become much more asset light. The composition of the S&P 500 has become more high quality in the last 20 years, and we've actually seen significantly lower financial leverage than here in the 90s as well as 2000s. These are very solid metrics, and yes, valuations are high, but the composition of the S&P 500 is different, and the companies now demand a higher valuation. Nvidia, guys, has a 57% free cash flow margin, so that means the $100 billion that they bring in, right, $57 billion of that is attributable to you, the shareholder, right? In the 90s, in the 80s, in the 70s, right? Companies were all just like manufacturing companies at banks with 8% margins. It was absolutely insane. The index deserved to trade at a 12 PE at that point. Now the index deserves to actually trade at 20 times, even more than that. And the S&P 500's valuation should continue to trend up, especially as companies become more higher quality and more free cash flow generative in the future. Let's actually talk about the macro in the here and now. Something we've looked at a lot lately is the Fed's GDP now, and we are sitting right now at 2.7% for the Fed's GDP now. After yesterday's ISM data, we actually did see a little bit of an uptick, as well as the JOLTS data. That's very, very good. If we can continue to see positive data for the rest of the week, we should see this get up to the 3% mark. That would be very, very positive, and the equity markets generally like a good growth story. Now let's actually talk about the labor market. Yesterday we got the JOLTS data. I brushed over it in yesterday's video. Now we're actually going to talk about it in depth. And the latest JOLTS report shows promising signs of a stabilizing labor market where 5.27 million hires were made, slightly down from the 5.4 million in October, with the hiring rate at 3.3% and the quits rate edging down to 1.9% from 2.1% in the month prior. And while both metrics are now below the pre-pandemic levels, this could actually be a bullish signal for the economy if you look at it in aggregate. A cooling but steady labor market may indicating we're moving past the overheated conditions of recent years, reducing wage pressures and helping ease inflation. This stabilization creates a more sustainable environment for businesses to plan and grow, setting the stage for longer-term economic resilience. And something that I actually like, probably my favorite JOLTS measure, is jobs openings per unemployed workers, and it's sitting just below the 1.2% range, and this is very stable and slightly below the Feb 2020 level. This metric is probably the major JOLTS metric we need to look at, and things are looking rather stable. Anything above 1 is very, very solid. So I think the labor market looks rather good. The market was spooked by some of the ISM data, but a lot of those surveys are actually very low quality and low volume and low breadth in terms of the survey participants, and should be taken with a grain of salt. But something like JOLTS, a very high quality data set, and there isn't anything right now in the JOLTS data that's telling me the labor market is falling apart. We continue to see cooling, and in certain aspects, we continue to see very positive things in the JOLTS data. Looking at earnings for the rest of the week now, I don't know if these stocks are actually going to report here on Thursday because the market is closed. I guess these businesses are still open and they can actually go ahead and report their earnings, but the stock market will be closed. Nonetheless, tomorrow we just have these names. Not much of anything I can see, but Friday's when it kicks off with Tilray, Delta, Walgreens, and Constellation Brands, guys. And then data for the rest of the week. Tomorrow, we just have initial jobless claims. That's it. What we are expecting is a 211,000 print. And then on Friday, we have non-farms, the unemployment rate, average hourly earnings, and the participation rate. Now, the consensus expectations for NFP is 150,000, 4.2% unemployment rate, average hourly earnings month over month, year over year to come in at 0.3 and 0.4% respectively. And then the participation rate to come in at 62.8. And then we also have Michigan Consumer Sentiment, UMich, and the consensus is for 74.5. So if we hit these numbers, Bob's your uncle. And if we look at the JOLTS hires number, that actually did come in slightly below market expectation, and that could be a barometer for what's to come here in the non-farms. However, if we actually look at the trading economics forecast, they see a 200,000 forecast. So I would say that the market is expecting anything in between here. Anything below, it's not going to be good. But we also want to look at what previous revisions to this number is going to be and how that's going to affect the unemployment rate. You can see the consensus is for 4.2% unemployment rate, but the forecast for 4.3%. So as much as this number matters as well, the revisions also matter with regards to the unemployment rate. The wage inflation is important with the average hourly earnings. That's very important. And then the participation rate as well. But normally that stays very, very steady. So I think a big non-farms print It's very hard to tell how's it going to go. Some of the economic employment indicators are saying that we might get a weaker non-farms. The market sort of have priced that in, particularly in yesterday's trade. However, anything can happen. It's virtually impossible to predict non-farms to a very accurate degree. So the best thing that we can do when it comes to something like the non-farms is react instead of trying to predict what's going to happen. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.